traders, for today's trade we're looking at a bull put spread in DocuSign. So taking a look at the stock on MarketSmith, DOCU may be turning around after a very long downtrend that began back in the final quarter of 2021. Shares are heading higher for their fourth straight month after many months of trading lower. Last week, shares successfully tested support at their conjoined 50-day and 200-day lines. The stock reclaimed its 200-day line in January for the first time since November 2021. This is certainly a bullish development and may mean the stock is about to make a comeback. Most notably, the stock has earnings right around the corner. DOCU is set to announce on Thursday after the close with an expected move of around 12.6%. So with today's trade, we want to structure a trade that fits the view that DocuSign will stay within this expected range following the earnings release and that the response to the report will be positive. Earnings make it tough to buy a stock outright, which is why options give us a better alternative for going long. A bull put spread is a risk-defined way of getting long. It's one of the 4 basic vertical spreads that you can put on using options and involves selling one put and buying a lower strike put. The goal is for the stock price to stay above the higher strike price to keep the full premium. If the stock price is below both strikes, the maximum loss will be realized. So let's take a look at my trading platform and set up a trade in DocuSign.
So to set up this trade in DocuSign, we're going to be using the March 10th expiration. And we are looking to sell 156 put. And then we're looking to buy one March 10th, 51 put.
Using the March 10th expiration, we can sell a 56 strike put and buy a 51 strike put to set up the bull put spread. In total, this spread will generate around $65 in premium with a maximum risk of $435. That represents a 15% return on risk between now and Friday if DocuSign closes above 56. The maximum loss would occur if DocuSign closes below 51 on March 10th, which would see the premium seller lose $435 on the trade. The break-even point for this trade is 55.35, which is calculated as 56 minus the 65-cent option premium per contract. There is little room for adjustment with short-term trades such as this one when held over earnings. Short-term trades also contain assignment risk. A 15% return in a few days would be great, but the possibility of losing 100% is also very real. Keep in mind that this style of trade is only for traders with high risk tolerance, so please size your position accordingly. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for more digestible options education and tons of great trade ideas. And be sure to join us for our regular options content where we break down a new trade idea here every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.